If interest rates go down, the dollar should weaken. But why is the USD the strongest in 20 years? This is not a coincidence. This is a strategy, hidden under the sweet name, monetary policy. You are listening to Ascend Your Mind, where I help you see what financial news rarely dares to say. Subscribe to the channel right now, because just by understanding this cycle, you will understand how the world truly operates. From there, you will know how to protect your assets and multiply your assets many times. Imagine the global economy as a vast forest. In that forest, millions of small ant colonies live relying on one giant ant colony at the center, the American colony. And inside that colony, there is a giant honey vault, symbolizing the flow of US dollars for the whole world. When the American ant colony opens the lid of the honey vault, the whole forest shares the sweetness. Sugar flows everywhere. Ants in Asia, Europe, Africa all have a share. That is when America is pumping money, doing QE, quantitative easing. But then, when it closes the lid and uses a giant straw to suck the honey back, all the other ant colonies begin to panic. Honey in their colonies gradually runs out. Small ants scatter in confusion. That is exactly when America begins QT, quantitative tightening. QT sounds complicated, but actually it is simply this. The Fed is pulling money out of the system. Instead of lending more, they begin to take back what they lent. Like someone who once scattered money across the neighborhood and now goes knocking on every door to collect every single dollar. When the Fed does QE, they pump money by buying bonds. That is, they print dollars to put into the market. But when the Fed does quantitative tightening, they stop buying or sell those bonds back. Cash disappears. Global liquidity contracts. The USD becomes scarce. But why does the Fed do that? Why drain money while the whole world is fragile after pandemic, war, and inflation? The answer is actually quite cold. Because the Fed does not work for the benefit of the entire world. The Fed needs to operate reasonable monetary policy to keep the U.S. from recession and protect the economic interests of the United States itself. When inflation climbs, prices in America rise. The Fed has only two ways. One is to raise interest rates to reduce consumption. The second is to pull money out of the system, QT, to reduce the amount of dollars in circulation. They chose to do both. But when they raise rates too high, the U.S. economy begins to tire. Businesses complain. The stock market sheds. What must the Fed do? They begin lowering interest rates, like a painkiller. But while lowering rates, they still continue QT. That is, still drawing money back from the entire system. That is the game of nominally cutting rates, truly tightening. One hand, the Fed soothes the market with the promise, "We are easing." But the other hand quietly opens the straw, pulling each drop of honey back to the central colony. What about the evidence? Look at the Fed's balance sheet, WALCL. In 2022, total Fed assets were over $8.9 trillion. By now, it is only about $7.1 trillion. That means in 2 years, the Fed has withdrawn more than $1.8 trillion from the system, one of the strongest QT phases in U.S. history. Every time the Fed lets a bond mature without buying back, a portion of money is erased from the banking system. And that is why the overnight rate between U.S. banks has surged above 4%. That is a signal of genuine liquidity shortage. When the Fed drains money, what happens to the rest of the world? All the other ant colonies, that is, emerging countries, begin to fall into a state of honey shortage because most global trade happens in dollars. Without dollars, they cannot import goods, cannot service debt, and must use their foreign reserves to defend the exchange rate. When dollars are scarce, the USD strengthens and their currencies weaken. That is exactly why the dollar remains strong, even though the Fed has cut rates. Because the amount of dollars in the system is still decreasing. In other words, the value of the dollar rises, not because America is healthier, but because the world is starved of money. And when the dollar strengthens, who suffers first? Risky markets, like crypto, tech stocks, speculative real estate. When money is scarce, investors no longer have surplus cash to pour into risky assets. They retreat to safe havens, and the first safe haven is the USD. Thus, Bitcoin, Ethereum, altcoins tumble en masse. Not because the technology is bad, but because the bloodstream has been drained from the body. That is why the Fed cuts rates, coins still crash. The Fed promises easing, the USD still rises. Because they are playing a global liquidity chess game, not a psychological comfort show for markets. You've probably seen documentaries calling crypto the world's greatest scam. But what if I told you the biggest money illusion wasn't in the blockchain, it was right inside the Federal Reserve? Because while everyone was staring at Bitcoin's collapse, the real liquidity trap was quietly set by the Fed itself. And more importantly, this is not just a financial story, it is a geostrategic instrument. After the U.S. and the West froze more than $300 billion of Russia's foreign reserves, every other nation realized a chilling truth. Money in American banks is not truly yours. Yesterday, it was a national asset. Tomorrow, it can be locked with just a signature. From that moment, a new wave began. De-dollarization. China began selling some U.S. treasuries, buying physical gold, and building its own payment system, CIPS, to avoid reliance on SWIFT. India and Russia settled oil in rupees. Brazil and Saudi Arabia experimented with payments in local currencies. All are sending one common message. We no longer want to be dependent on the American colony. But to separate from the dollar, they need a foundation, something that cannot be printed, cannot be frozen. And that thing is physical gold. Therefore, while the Fed is draining money, central banks around the world are quietly accumulating gold at a pace unseen in 50 years. According to the latest figures, in just the past 2 years, countries have bought more than 2,000 tons of gold, led by China, India, Turkey, Singapore, Kazakhstan. Why? Because they understand, when the Fed continues QT, all paper assets will tremble. But gold, the asset that depends on no one's promise, will hold firm. If we look at the big picture, we will see a giant cycle of global money. 1. Fed QE. USD floods the world. Countries flourish. Gold declines. 2. Fed QT. USD is scarce. Countries print domestic money, creating local bubbles. 3. When the bubble bursts, the Fed QE again. USD weakens. Gold and commodities surge. 4. The cycle repeats. And right now, we are between phase 2 and 3. The Fed still does QT, but markets are breathing oxygen substitutes from other countries. Countries are printing money to survive, while the Fed is withdrawing money to consolidate strength. This is the period of preparation for the biggest reversal in many years to come. Now we return to the biggest question. Why must the U.S. do QT, even knowing it will push the world toward recession? Because QT is a soft power instrument. No bullets fired, and yet pressure spreads. When the USD is scarce, countries indebted in dollars will choke. Their currencies fall, they must sell reserves, sell assets, even sell gold. And precisely then, American financial giants can buy back everything cheaply. That is the drain, release, acquire cycle used for decades. Drain money so the world thirsts for capital. Open the QE valve to buy back the very assets they once lost. Repeat. Therefore, the story is not only economics, it is global financial power. The Fed is the queen ant, the USD is the honey flow, and the world is the ant colonies depending on that flow to survive. But this time, other colonies have begun to wise up. They are stashing real honey underground, gold. And when the Fed must stop QT, when the first signal of QE appears, gold will not just rise, it will erupt. And here is the most important thing for every investor listening to this story. If the U.S. is still in QT, do not believe too much in promises of rate cuts or stability, because interest rates are only the surface, while the money flow, the true bloodstream of the economy, is still being drawn out every day. When global liquidity contracts, only physical gold preserves value, not paper gold, not CFD contracts, but real gold, the thing you can hold in your hand. This is the period when those who understand the QE cycle will keep real assets, while those who chase the mirage of coins, stocks, or paper money will be drained once again. Remember, when the Fed drains money, gold stays still. When the Fed is about to QE, gold flies like a kite. And when gold flies, it will not wait for anyone. Therefore, if you want to protect your assets, start accumulating physical gold right in the phase when everyone is still confused. Do not buy out of fear. Buy because you understand how this system operates. The Fed will not do QT forever. There will come a time when the signals begin to appear. The Fed's total assets stop falling for 4 consecutive weeks. Interbank overnight rates spike. The RRP buffer is depleted. U.S. Treasury auctions go uncovered. And unemployment exceeds the 5% threshold. When those things happen at once, that is when the Fed is about to reopen the honey vault, beginning a new QE. And then, gold will not just be a safe haven, but the ultimate financial survival tool for every individual and nation. If you want to know the exact moment that happens, if you want to know when to take profits on gold before the next cycle begins, hit subscribe and turn on the bell right now. Because in the next video, we will show you the 5 real signals that the Fed has reversed and how to prepare your portfolio before the honey vault opens once more. Ascend your mind. Decode the markets. Protect your future. Let's decode the markets and protect your future.